Hey, welcome back. It's Nolan Mathias, and in today's 5-Minute Friday, we're going to discuss the basics of short squeezes. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where when we hit 10,000 subscribers, we're going to pay one lucky person's mortgage or rent payment, and all they have to do to enter is hit the subscribe button. So go ahead, hit that subscribe button. It's easy, it's free, and it's totally worth it. Okay, so let's get into it. Let's discuss short squeezes and what they are, because they have been the primary topic in the news cycle this week with what's going on with GameStop, AMC, BlackBerry, and a bunch of other different companies that are being squeezed by a group of Redditors called Wall Street Bets. And in order to understand how a short squeeze works, we first need to understand how short selling works. And this is a really simple explanation of how short selling works. Basically, when you're short selling a stock, you are borrowing a group of stocks from your brokerage, and you are selling it into the open market. And what your hope is that the value of the stock is going to go down so that when you buy it back and give it back to the brokerage that you borrowed it from, that you are going to earn a profit, because what you sold it for less what you bought it back for ends up being your profit. And that's how short sellers make money. But the problem with short selling is that if you are in a situation where the value of the stock goes up instead of down, well, you start to incur losses. And unlike a long position where you're buying a stock and holding on to it, if you short sold a stock, your losses are potentially infinite, because in a long position, your risk is the amount of money that you invested. So let's say you're buying a stock to hold it and the value goes to zero. Well, your potential losses are what you invested. But in a short position, your potential losses are infinite. So for an example, if you were to short sell a stock for $10 and instead of going down in value, that stock went up, and let's say it went up to $20, well, you've now lost $10. But if it goes up to $100, you've now lost $90, and so on and so forth until such time as that stock basically maxes out in value. And that's what's brought us to today and the conversation with respect to short squeezes, because what has happened is that in the case of GameStop, there has been a recognition that short sellers have borrowed more stocks to sell than what actually exists in the market. And what that means is that it becomes very hard for the short sellers to cover their position and limit their losses. So this group of Redditors, Wall Street Bets, figured this out and is basically putting upward pressure on the stock by buying call options and buying the stock itself in order to push the value. And the higher that the Wall Street bettors push the value of the stock, the more that the short sellers have to lock in their losses. And in order to lock in their losses and cover their losses, they have to buy back the stocks. And as they buy back the stocks, well, guess what? That adds more upward pressure, which means the value of the stock goes up and up and up, and then more shorters have to cover and cover and cover and cover. And it basically becomes this infinite loop of short sellers having to cover their losses as the stock goes higher, which continues to push the stock higher and higher and higher. And eventually what ends up happening is the short sellers either have to completely give up or they go bankrupt. And this isn't something that's new to the market. GameStop isn't the first company to get short squeezed. It happened to Volkswagen back in 2008. And it's very much something that investors and institutional investors do when they see that there's large short positions on a company and that there's an opportunity to push those short positions into a position where they have to cover and therefore push the value of the price higher and higher and higher. Now, this last week is the first time that a group of retail investors, or what's called basically amateur investors, have been able to short squeeze a major institutional investor or a hedge fund, but that's exactly what happened. And for whatever reason, all the stars aligned into this perfect scenario where a group of Redditors were able to recognize that there was this opportunity and continue to push the stock, and in this case, GameStop or AMC or BlackBerry, higher, higher, and higher, to make these hedge funds and institutional investors cover their short bets on these companies. So this is really a once-in-a-lifetime situation where you see retail investors taking on the giants. It's very much a David and Goliath story. The short squeeze itself is not something that is new or something that is unknown to the market, but definitely the circumstances over the last week and how this has played out is new to the market, because never before has a group of retail investors been able to manipulate the market in such a way that big hedge funds and big institutional investors have to take their losses. And really a cool scenario where we're seeing hedge funds have to take their medicine, where normally it's the retail investor who gets screwed in a lot of these situations as opposed to the big institutional investors. So that's it. That's how short squeezes work. That's today's 5-Minute Friday. Hope you enjoyed it. Again, hit that like button, hit that subscribe button, and don't forget about our race to 10,000 subscribers, and we'll see you on the very next video. Cheers.